Hello, everybody, and welcome to our webinar this afternoon. It is May 5th, 2020, and I am off screen. I am Kate Kilberg, and I will be moderating this webinar. On your screen, you will find Nate Funk, who is a business lawyer at Catalyst Law, Kimberly Pray, a nonprofit and business lawyer at Catalyst Law, and Craig Hill, who's our banker at Beneficial State Bank. We're going to be talking today about maximizing your PPP loan forgiveness. Before we get started, just a few reminders. These webinars, the webinar series that we're running here is intended to be educational advice, not legal advice. And we will do our best to answer all of your questions. So as the presentation is going along, please feel free to enter questions in the chat screen on the right of your screen. We will try to get to all of your questions, time permitting. We're going to start with an overview from Nate and Kimberly of what the latest guidance on the PPP forgiveness says and have their legal perspective. And then we'll turn it over to Craig for a short question where he can update us on what he's common questions that he's received and what he thinks it's important for all of us PPP borrowers to know. So with that, I'm going to turn it over to Nate and Kimberly to start talking about the guidance that we do have from the SBA about what will be forgivable from a PPP loan.
Great. Thanks, Kate. Welcome, everyone. Thanks for joining us. As Kate said, we're going to start out with a little overview of of the Paycheck Protection Program loan program, and then get into some more of the details, I guess, about what is allowed as expenses for forgiveness, what isn't, and then some of the other issues. I think in general, our kind of perspective on it, as this seems like a very helpful and good program, but there's, as with any, I guess, statute or program this large and put in place this quickly, there certainly are some ambiguities and uncertainties and questions. Hopefully the SBA will come out with some additional guidance. They've already provided quite a bit of guidance on some of those questions and issues, but there still are some that are relatively uncertain. So starting out, one of the biggest questions or issues that most people have once they get their PPP loan is what costs and payments are forgivable. So what are those allowable expenses? In the statute itself, it talks about the specific kinds of costs and expenses or costs and payments that are forgivable. For the most part, those include payroll expenses, which include not only cash compensation like salary, wages, and tips, but also non-cash compensation. So employee benefits, health insurance, premiums. It only covers the part that the employer pays. If there's any portion of the health insurance benefits that the employee pays, that part is not included. It also includes taxes that are paid on the employee's wages, so the part of the payroll taxes that the employee pays, but not the part that the employer pays. It's not entirely clear in the statute, but the general consensus seems to be that compensation like bonuses, hazard pay, and things like that are also included. Again, we're hoping for some additional guidance from the SBA on some of those issues, but the general consensus seems to be that those are included. Beyond those payroll costs are interest, what they call interest on mortgage obligations. And again, that's interest only, not the principal. And in this case, the mortgage obligation isn't what we might typically think of a mortgage as our house. It's really any debt that is secured by collateral. It can be personal or real property. The only other caveat, I guess, is that it has to have been in place before February 15th, 2020. You can also use the funds to pay interest on other loan obligations that aren't considered mortgage debt in this case, but the interest, if you pay that interest, it's not forgivable. It's an odd little carve out in the statute that says you can use the funds for that purpose, but it's not forgivable for that interest. So only what they consider mortgage loans, so some type of loan secured by collateral. You can also use it for rent which obviously would include rent on any type of real estate, your office, your warehouse, things like that. But some of the SBA guidance indicated that you can also use it to pay lease payments on a company vehicle, for example, or other equipment that you lease. So basically any type of lease that you have, you can use it for those purposes. And otherwise you can use it for utilities. And they specify in the statute that it can be electricity, gas, water, transportation, telephone, and internet service. Not entirely sure what transportation means. Perhaps they'll come out with some additional guidance on that, but otherwise it's the traditional or standard utilities you might find. Again, with all of these though, they have to be in place. These utility services, the rent, the leases, have to all have been in place as of February 15th of this year, 2020. There's some of the questions though that people have related to these allowable uses are for the payroll costs, whether, so you have this 8-week period to use your funds, and whether the payroll costs have to be just incurred during that 8-week period, or if they also have to be paid during that 8-week period. Our interpretation of the statute and some of the guidance that has come out is that you want to count the ones that have been incurred during that period. So even if your payroll cycle, if you actually pay your employees after the 8-week period, if you incurred those costs during the 8-week period, you would include those. We're hoping for some more guidance on that as well, though, because obviously differing payroll cycles for many companies might cause some questions or uncertainties around that. It does seem clear, though, that you can't accelerate any type of payment. So if you have rent, for example, due on your office lease, you can't pay the next 6 months up front. It's only the payment that is actually due during that 8-week period. The same thing for any other type of lease and the mortgage interest obligations as well. One other, I guess, special consideration or rule is for anybody who's considered self-employed or a sole proprietor. The SBA has said that you are limited in what, so it's the same, I guess, bundle of costs or payments that you can use it for, but you're limited. You have to have also had that expense and included it as a deduction in your taxes in 2019 to use it this year. So for example, if you used to work out of your house and didn't pay any rent, signed a new lease for some office space as of January 1st, 2020, you wouldn't be able to use the funds for that lease payment because it wasn't an expense that you had in 2019. That's one of the, I guess, differences between small businesses in general and the sole proprietors. And now I think Kimberly's going to talk a little about what some of the other things that are not forgivable.
Yeah, thanks, Nate. So anything other than the costs and payments that are listed in the statute and that Nate just outlined, those are not forgivable. And that includes the federal withholdings. So some payroll providers have a calculator that will be able to help you, determine what parts of the payroll you can use and what parts of the payroll you have to pay with your own funds. But that's the federal withholdings for those employees is what you're going to be looking for. Any employee that for state income tax, any withholding for state income tax, any other employment benefit, such as retirement benefits, healthcare benefits, those all can be included. Payroll costs for non-U.S. employees, however, are not eligible for forgiveness. Payments to independent contractors are not forgivable expense. And that's because independent contractors can apply for a PPP loan as a self-employed individual. So you want to make sure that you let them do that, and there still is are funds being lent. So if you haven't applied already, you still have time to do that. If any of your employees are taking qualified emergency family or emergency sick leave, that is not forgivable because you're getting a payroll tax credit to pay for those emergency leave employees, and you don't want to double dip. So If you have folks taking emergency leave, make sure that your numbers are matching up. Any non-payroll payments that exceed 25% of the forgiveness amount. So, and that's that's, you've got to just keep most of this for payroll, and I think that's going to be the guidance that that we're going to stick with, is that you want to make sure that you're conservative and use as much as you can for payroll, and then if there's some left over you can't use for payroll, then looking for those other allowable expenses. And then cash compensation in excess of $100,000 per year. So if you have employees who make 6 figures, the money from this PPP loan has to be limited to, and it's prorated for the 8 weeks, to $15,384. So you can still pay the person their full salary, but only for those 2 months, $15,384 can come out of the PPP loan. So we'll talk about it later, but tracing and not commingling funds is an important way to actually demonstrate that if you are paying someone over 6 figures, that only a portion of it does come from this loan. And the loan forgiveness can be reduced if you decrease the salary of someone by more than 25% for those who earn less than $100,000 annually. So for those of you who may have asked your employees to take a pay cut in the last several weeks, just make sure that that pay cut is not more than 25%. You can also give, as Nate said, you can give raises as part of this. You can get them back to their full salary if that's something that works out for you financially through the PPP loan. And then the forgiveness is reduced if you decrease your total number of employees, unless so you can have one employee leave and one employee come on within the 8-week period, but at the end of the 8-week period, you have to have the same number of employees as you did when you started, when your loan proceeds were distributed. So the next thing that is an area that you want to pay attention to is that you only have 8 weeks from the date of disbursement from the bank to use the loan proceeds. So it's really important that you map out ahead of time how you're going to make those disbursements and make sure that it is then really well documented. And if you don't use the loan proceeds, the repayment is over 2 years from the date of the loan. So the interest rate is at 1%, and payments can be deferred for 6 months. But then really know that, even though the interest rate is low, it's an 18-month time frame to repay those funds. So, so it is in your best interest to try and maximize the forgiveness here. And then any limits on the use of funds after the 8-week period is unclear. So as Nate said, we are waiting for some additional guidance from SBA on the paid or incurred question. And so if you were to pay payroll outside of that 8-week period, but the actual with the loan money, but the costs were incurred during those 8 weeks time, we're still kind of waiting on guidance to make sure that that's the correct interpretation. So I think with the overview, we're getting a lot of really good questions and comments. Maybe Kate, we want to go through some of them now,
I was
and
going
then
to suggest is why don't we take a break and kind of go through some of these questions that have come in so far and keep them coming, and then we'll turn it over to Craig to talk to us about what he's seeing at the bank. And Craig, why don't you come back on screen so you can jump in to answer any of these questions as well? We'd love to hear your perspective. So I'm just going to start with some of the earliest questions, and I'll read them out loud, and then we'll answer them, and then we'll turn it over to Craig for a little bit more of a presentation. Okay, let's see. So the question is, does it include employer retirement contribution? And I think that means, is employer retirement contribution forgivable?
I can handle that one. Yeah, and I've tried to answer a couple of the questions as we're going in the chat, but I'm happy to obviously go over some of those again. Yes, employer retirement contributions are included as a payroll cost. So those, you're obviously free to continue to make those and include that as a
Question for you,
forgivable
Nate.
cost.
Just taking it one step further, is employer retirement contributions, are those treated as cash or non-cash contributions for purposes of payroll costs? Do you have an answer? Do you know?
I know I've kind of made a distinction between cash compensation and non-cash compensation, although I don't know that the statute necessarily makes that distinction as clear. I think it would be considered. They talk about compensation being wages, salary, tips, things like that, and then other compensation, whether it's non-cash as far as some type of retirement contribution or insurance, health insurance.
Would it be
payments,
included
like
in
that.
the $100,000 cap?
Sorry. So as far as that, the only thing that's included in the $100,000 cap is that actual cash compensation. So salary, wages, tips, that the actual cash compensation. Anything else is, even if it's sort of paid in a sense, whether it's a retirement contribution or the health insurance premiums, those are not included as far as that $100,000.
Yeah, that's our understanding at the bank as well, is that wage income is its own unique category as a W-2 wage income, and it is separate from all other ancillary benefits paid. So if you had somebody making $99,000 a year in wage income and then $10,000 between healthcare and retirement, you could still pay them their full wage and their benefits, even though that would exceed over $100,000 in compensation annualized.
Great, thank you. So then we have another question from Cheryl who says, can we review what payroll taxes are counted in payroll costs? In Oregon, would it include TriMet and state unemployment insurance?
Yes. So anything, so payroll costs are calculated on a gross basis. So what you're going to include everything with the exception of the federal taxes imposed or withheld, such as an employee or employer share of FICA, and income taxes required to be withheld from employees. So state taxes, local taxes, anything else withheld other than that employer share of the FICA and income taxes, that is a qualified expense.
Yeah. The statute isn't obviously clear because there's tons of different kind of state and local taxes, but I think the language they use, which I think I copied and pasted into the chat, is that the payment of state and local taxes assessed on compensation of employees. So like Kimberly said, the key is that it's assessed on that compensation, whether it's kind of paid or withheld, but it excludes any type of taxes that the employer pays, that employer's share of those payroll taxes.
The next question, one of the big questions that you've already pointed out is, must the costs be incurred or paid? If we are going to be under the 25% allowable for rent and utilities, can we prepay several months worth of rent and have that considered as paid? And I think you already answered that we don't want to prepay rent. But Nate, you and I have debated the incurred versus paid thing a little bit. And my argument was, just for the benefit of the attendees, is that if you're going on an incurred basis and you actually pay it outside of the 8 weeks as an employer, I would be concerned that wouldn't be forgivable because it was paid outside of the 8 weeks. So I would prefer to pay it within the 8 weeks and argue that it's prorated for the 8-week period, even though at the time the payroll ran, there may have only been, for example, 5 days of actual work that would have been part of that pay period.
Yeah. So I guess first as a caveat, there's a lot of confusion and questions about this. part of it. It's not entirely clear. And I have to expect that the SBA will come out with some guidance on this, hopefully sooner rather than later. Help everybody kind of understand how to handle this situation. And I guess another comment I would say is just to more or less continue your operations and everything as you normally would. I think if there's any trouble to find it, I think you would find it by trying to accelerate payments or trying to squeeze things into that 8-week period that otherwise would fall out of it, by paying things in not in the ordinary course of business like you typically have. And obviously, as Kate said, there's very differing interpretations on the costs incurred versus paid language. My thought on it is that it specifically refers to payroll costs, and all the other utilities, mortgage interest, and rent, it refers to generally as payments. And also the primary purpose for the Paycheck Protection Program is to keep employees on payroll and to pay them. So whether or not you actually paid your payroll during that 8-week period, I think the purpose of having those people, supporting them to be employed during that 8-week period, and obviously that would be incurring those payroll costs, not necessarily paying them, would satisfy that purpose. And then the other costs that are allowable, they kind of lump them in and say, if you happen to pay those during that 8-week period, you can include those as well, up to a maximum of 25% of the total forgivable amount. And whether those were incurred at some other time, I mean, I guess, arguably your entire amount you owe under a lease would be incurred at the time you sign it. So I think they're trying to avoid some of those arguments, or not allow people to prepay a bunch of rent up front and lump it into that forgivable amount. But as I said, there's people have different interpretations of it, and I certainly don't know that mine is absolutely correct. And I think as with everybody, we're really hoping the SBA will provide some additional guidance so we can stop wondering about it and theorizing and just know what to do and how to handle it.
Did you have something to add, Craig? So the other piece of this that I know is sort of interesting is that it's going to be up to the lenders to be sort of certifying whether costs are forgivable. And so I'd love to hear what the bank is thinking on this, Craig.
First off, don't count on it. I can tell you right now that the large banks and folks over here that are really focusing on doing large volumes of loans that are basically anonymous, they are not going to help you with this. And so you do not count on it. And I don't mean to be a pessimist. I'm an optimist at heart, but it's absolutely unreasonable to think that they're going to be of any assistance beyond here's a spreadsheet and track it. So that's kind of my first guidance that I give folks at the end of the day is create a spreadsheet and start tracking your expenses. And I just created a folder in my personal drive, if you will, or wherever, like some shared drive that you have, lump it all together just and say, this is my folder for PPP tracking. And I'm going to have a spreadsheet in there and it tracks whether or not it's a payroll cost, because that's a big differentiator, and when it was incurred by the date, and then just save a PDF in that folder of that expense. Print a PDF is probably a function that many people have learned to love during this past 8-week period of realizing that you don't have access to a printer. Maybe that's just me. So yeah, one of the things we can go back to some of the questions, or I can kind of give a little bit of spiel about what I think from a banker perspective of what we've seen and some of the general questions, and kind of, I think it's been helpful to walk through with a variety of different types of folks, really your 3 outcomes that can happen with a lot of this if you act in good faith, which is what this whole legislation says, the word good faith at least a dozen times. So we're hoping that good faith means good faith, because it would be pretty bad faith to say good faith 12 times and then change the rules. I also wouldn't count on the SBA to provide a ton of guidance immediately, because we've been making loans as banks now for over 5 weeks, and there's still a lot of guidance that isn't clear or crystal clear that's been evolved as those loans have been made. So if we're good to get moving on a presentation, we want to stick to any questions. I'll leave plenty of time after this one's over, after this kind of presentation gap. What do y'all think?
Why don't we go ahead and run through your slides, Craig, and then we can get back to the questions. And I'm willing to stay on as long as it takes to get through everyone's questions. I don't know if the other presenters have the same amount of time, but I'm certainly happy to stay as long as it takes. So let's go ahead and have Craig go through his slides that he presented, and maybe that will answer some of the questions, and then we'll run through the questions.
Perfect. Can you all see my screen now?
I can see it. Yep, it looks good.
Perfect. Awesome. Well, I was starting in the middle of the presentation. So there's really three options I think you need to think about with this. And it seems really simple to say this, but I also think it's important to remember. The first option is that your loan is forgiven in its entirety, which means, for your entire loan amount, it's entirely forgiven. Congratulations, you did it. The second option is to think that your loan is partially forgiven, which leaves you with some loan balance of some amount. Or finally, your loan is not forgiven at all and remains a true loan for the amount it was made. And these slides will be available as a handout for afterward, and they're really just meant as a framework to be thinking about what happens if something isn't forgiven. So there's a lot of text on here, but I want you all to think about, you need to spend at least 75% of the money you use on payroll and payroll costs, and those healthcare, employee wages, taxes, retirement, et cetera, that are incurred during the loan period. And we talk incurred versus paid. I always say if you incurred them during the period or you paid them during the period or both, just be consistent. Don't take what works for you in one situation and then pick something different in a later situation. The other 25% must be spent on rent, utilities, and mortgage interest, not principal. So this is important. We've talked to a couple folks about it. If you have a building loan of a building you own, and you will be paying yourself, basically they're considering it you paying yourself if you use the mortgage principal as part of your forgivable costs. So it's really only interest that's included. We have heard that like postage, printer expenses for rented printers, things like that, provided they were before the February 15th guidance of pre-COVID crisis. And I say this here in point 3, which is something I was saying earlier, you must do the tracking. Your bank or the SBA will not do it for you. So please remember that as you're going through this process, that you need to be tracking this as you go, and it's a whole lot easier to do that up front than it is to try to do it later. And I think the biggest piece of reminder is number 5. You do not have to spend all of this money. I think maybe you do to have to stay in existence. Maybe you don't. But you could pay back the funds at no expense at the end of the 8-week period if you don't use them all. So it's helpful for some folks who are really having a hard time and need to take some deep breaths over, what do I do with this money? What if I don't spend it all? I want it to all go. Is maybe think of it less about what you can include versus what do you need it to cover for you to have time to pivot your business to survive this crisis. Option 2 is about partial forgiveness. So if you not spend at least 75% of the loan proceeds on payroll and payroll costs, your loan will not be wholly forgiven. And it may be disqualified partially or entirely from forgiveness. They haven't provided a ton of crystal clear guidance on it, but our expectation from an example given by a regional SBA administrator was that if you spent 65% of your loan on payroll costs and the other $35,000 you were using on other non-payroll related costs on that side, $65,000 of the $100,000 would be forgiven, leaving you with the $35,000 loan. The payments can be deferred up to 6 months, and they'll be fully due within 24 months of the loan origination date. So if you got a loan today on May 5th, 2020, that would be fully due on May 5th, 2022. And an interest rate of 1% is really something, but amortization is steep for repayment. So just remember that a 10-year period is very different than a 2-year period. And this is a 2-year period. So $10,000 over 18 months is one issue. $100,000 is another. And lastly, there's the no forgiveness option. If you do not use the funds on your payroll expenses, but your business in general, you are likely not going to qualify for any forgiveness. If you have money left over or this isn't forgiven, this may not be the end of the world for your business. I've talked to several restaurant owners, small businesses, and if you told them, hey, you could have a loan of 1% underwritten during a crisis with no personal guarantees or demonstration of cash flow and no fees that you have to pay, is absolutely bonkers. Like the banking industry would never give you a loan like that. So don't lose sight of this if you need these funds to keep your business afloat during this time frame. I really do believe in a personal level that there's going to be chances to refinance this debt, that maybe a cottage industry pops up out of this of buying up some of this debt and offering 5, 7, 10-year amortizations of the debt at a higher interest rate, but a lot longer amortization period may really benefit your business. And lastly, some businesses may be better served by bringing back just part of their staff or spending their loan on pivoting their business to being a more resilient or sustainable business model. Not just to read off the slides, but I want to make sure that's clear to folks to say, if it makes more sense for you to take this money and pivot your business and have a loan that you owe at the end, is that better than just staying afloat for 2 months and then your business going under? Just a kind of thing to consider. And And as a banker, I don't encourage people to go one way or another, but rather evaluate all the options you have and what makes the most sense for you. So I stopped sharing. I think that should have done it.
Okay.
And now I'm the only person on the screen. So if anybody else wants to come back, go to town.
Thank you so much, Craig. That was really great.
Cool.
I'm gonna. I keep interrupting you. Why don't you say your bit and then we'll jump into more questions?
Totally. Just all in a way of saying on this side, if some of you know me, some of you don't, is to say that we really want people to feel like they have a grasp of what this program is and is not. And a lot of the time, the best advice we can give is if you don't understand something, don't sign it, right? Is usually a good sign. If you don't need a loan, don't get one. But once you have the loan, think of it as this isn't actually fully a loan that you owe and have anything done for until after the forgiveness to this 8-week period is over. So if you got a $100,000 loan and $50,000 of payroll to bring people back and use that side, and then you have the other $50,000, you spend $5,000-6,000 on some expenses, and that leaves you with $40,000+ over there, rather than trying to accelerate payroll or trying to accelerate something to fit into this time frame, maybe you just don't pay that back. Would it be great to have more money to spend on business? Of course. But at the same time, is it better to have it forgiven and have some wiggle room in there? And if you're talking good faith, I think it's pretty good faith to say, I got a $100,000 loan and I only spent $85,000 and I'm paying $15,000 back, is a pretty good faith demonstration that you were trying to be prudent with the use of these funds rather than deciding to just go to town and spend all the money.
Great. Thanks, Craig. So I'm going to go to our next question from Shelley, who asked, sole proprietor who's been collecting unemployment now has a PPP loan. He will lose unemployment benefit while he has the PPP loan. Since those funds need to be spent within 8 weeks, can he resume claiming unemployment after the 8 weeks?
From everything we've heard, as long as it's after June 30th, if you got a loan prior to when your 8 weeks would run out, if those 8 weeks would run out before June 30th, that's a different situation because June 30th is the true hard stop end of the program, is what they were saying. So that's if you got a loan and on April 15th and it expired June 13th, you couldn't qualify for unemployment benefits, I believe, until after June 30th. Because you'd need to certify as of June 30th that your payroll looks similar to what it did on February 15th. If you're self-employed, that might be a little bit different. But if you go on unemployment, then your employment went from 1 to 0 in theory, which may disqualify you from some forgiveness of the PPP program.
Yeah, that's great. And that's something where we can, I don't know if Kimberly or Nate have another answer to that. If we don't, we can certainly contact you separately, Shelley, and get you a more comprehensive answer from the employment law side. The next question is from Kristen, who says, how do we use Catalyst for the PPP? Will you help maximize our loan forgiveness? And I'm going to ask Kimberly, who's done the most thinking about what our offering is and how we can help.
Yeah, so we are available to help both with calculating and making sure that you're kind of taking the record keeping procedure, in a that you're thinking through kind of what's needed on the lender side. As you're working with all different types of lenders, we're also going to be available as you're submitting those requests for forgiveness, so that as we're starting to see some different interpretations of the rules and the law, that we can then advocate on your behalf if there's an issue that comes up during that evaluation. So we want to, number one, help prepare our clients to maximize their forgiveness if that's what they want. So having that conversation about what's the money going to be used for, and then how do you track it? And then, what are the documents that are required for record keeping, and then making sure that we can that we have a defensible position in the event that anything is not forgiven by the lender.
All right, then the next question is, can one-time contributions to employee 401k retirement be included? And I'm going to actually expand this question to, another question that I've heard is, can I, for example, pay more of a health insurance premium for my employees? Or can I give a bonus to my employees? Or can I give hazard pay to employees who are coming to work during this dangerous time? And I don't know, do any of you want to comment on that?
The hazard pay things we've got a few times from grocery stores and a few other folks who are asking about it. The guidance we've been given is that in theory, it should be fine if if you're not paying somebody what would be in excess of $100,000 of wages, which that's always going to be a hard stop in this. As a community banker on this side, it seems absolutely baffling to not allow that to be the case if that's a true cost of doing business. During this crisis, if these people, what if your employees don't wish to come back, right? Has been another question. When tendered a letter of, re-employment, basically asking them to come back, the guidance we've received on that is that if you put it in writing and your employee refuses to come back, the amount that you use to calculate their payroll costs for your loan, you would potentially still be eligible for forgiveness. You're not going to be penalized for not having that number of employees as of June 30th, but you should probably not use the money and expect it to be forgiven in general. They're like, well, what if I paid somebody else extra money to do the work that person didn't have? And the answer on that stuff is still kind of murky, but the expectation is that's good faith of what it cost you to keep doing business, and you still spent it on payroll costs rather than, say, owner's equity draws or prepaying other expenses during the time period.
Mm-hmm. Yeah, and I think that's generally, our interpretation or understanding of it as well. I think other than that $100,000, annualized cap on cash compensation, there doesn't appear to be at least any explicit or specific limitations on, kind of on the upside. It doesn't say that you can't make additional contributions to retirement accounts or pay more of the health insurance premiums than you were paying before. I think as far as, I mentioned earlier about doing things differently than you have in the past. If you are going to do anything differently, I think erring on the side of the payroll cost is probably the safer way to go. Because again, the primary purpose of the program overall is to keep people employed. And I think there's an easy argument to be made that, perhaps by increasing those contributions or paying them a little more, again, as long as the actual cash compensation doesn't exceed $100,000 on an annualized basis, that, I don't imagine there'd be a major problem with those things. I think the other issues might arise when you start trying to cram in other expenses that might have otherwise fallen outside of that 8-week period.
Great. Okay, our next question is from Richard. Hi, Richard. His question is rent. I work with a domestic violence survivors organization. We pay rent on several apartments that serve as a scattered shelter site for survivors of domestic violence. Would that rent qualify? This is an ongoing lease we have, and we pay whether or not we have a client housed there.
That's a good question. I think there's an argument that it could be included. The rent, the reference to rent in statute is pretty vague. It just says rent. Some of the guidance the SBA put out did mention other types of non-property leases, like equipment or vehicle leases. And in this case, obviously, it is a property lease. I suppose the concern would be that it's a general operating cost as opposed to a true rent for the organization or the company. But and again, that would either way, you'd want to be careful not to exceed that 25% maximum amount for the non-payroll cost. But obviously, Craig, be happy to hear what you have to say. But I would think there's a good argument to be made that would be included since it is actually rent.
Yeah, that's kind of what we've been given too, as always, taking a big, huge pinch of salt and throwing it over the shoulder kind of thing, is that hoping to just say, again, with good faith, if this is a true cost of you doing business and working with the Domestic Violence Survivors Organization, and this is a cost associated with providing those services, that's a rent that you're paying as part of a cost. That seems reasonable. It's just, is the rent part of your actual payroll cost? Is this actually the cost of you keeping your people employed versus a cost of doing business like working capital? So it's a little squishy, and I wish there were better guidance that was released over here. It's still absolutely baffling to me. I use that a lot, that we're in this space where we're expected people to be taking hundreds of thousands of dollars, if not millions of dollars, and not have crystal clear guidance on what's in and what's out. But again, I go back to that good faith piece, document everything as much as possible and make sure that you're categorizing it as a payroll cost versus non-payroll cost, and making sure the non-payroll costs are for the correct items that because you did have to mark on your application when you got your PPP loan what you'd be spending the money on. And it was payroll, rent, utilities, or other. There was an other category. And if you didn't mark the other category and you start spending it on some other, I think it's a little bit tougher to know whether or not you didn't signal you'd be spending the money on that.
Okay, great. Thanks for the answer. So then Marianne asked, just to clarify, is regular sick leave allowed? And I think the meaning there is regular sick leave pay forgivable? Everybody says yes.
I think so. The only exclusion from that sick or family leave is they call it the qualified sick and family leave wages, for which the tax credit is available under the Families First Coronavirus Response Act. So there's a very specific type of leave that has been allowed under that, and there's a tax credit available for payments made for that. So that's excluded. Otherwise, it just kind of broadly says family and sick leave.
That's a great, and that leads into the next question from Sharon, which says, if the employees take emergency federal leave, and I'm guessing that we mean under the FFCRA, but we don't ask the government for reimbursement for that time, can we still get forgiveness for that amount?
As with everything possible, that there'll be more guidance. My initial, reaction would be probably not, because it doesn't say that the statute says qualified sick and family leave wages for which a credit is allowed under the statute. So whether or not you take advantage of it, it was still allowed. And also, I think you'd have to make your request for forgiveness relatively soon compared to when you would actually make the claim for that tax credit. So I suppose theoretically you could request forgiveness for that, claim you're not going to take the tax credit, and then take the tax credit. So my guess is they'd want to avoid that possibility and just exclude it entirely. But I'm not aware of any specific guidance on that, but it does, at least the plain language seems to just say if it's allowed under that statute, it's not forgivable expense.
Great, thank you. So the next question is, what if you just hold the funds in a savings account?
You held them in a savings account. Not to oversimplify, it's we have some folks who, and I see Daniel's question later is very similar. Like, do I need to keep the funds in its own account? Like, do I need to do something else? And that's the AICPA, the American Institute of Certified Public Accountants and things, had said that they were making that recommendation, which is cool for them. They're not a bank, so that's really easy for them to say. Has been my joke that sure, let's open up thousands of new checking accounts that are just for a short-term thing. I think if it helps you understand it and document it better, then that could seem like a good move to for documentation. If you put it in a savings account and you just make transfers out, savings account under Reg D, as asking a banker, Regulation D says you can only make 6 withdrawals from a savings account per statement cycle. So just be cognizant of that if you need to make more than 6 withdrawals per statement cycle, a lot of savings accounts are on quarterly statement cycles. So you'd only be able to make 6 withdrawals during this quarter, which this whole loan program is administered during Q2 of the year. So probably something to just be wise, pay attention to. Some savings accounts, like money market accounts at most places, have 6 withdrawals per month, which is probably more allowable. The cleanest thing that I've seen people doing just out of that side is actually writing a check for the various expenses they're doing and just writing in the memo line what they were paying it for. And that could be something where people saying, well, what about payroll or what about anything else? It's like, well, if you document that expense by writing a check for it and then deposit it into your account, you can see the image of what it was for, and you have a check copy for it or a canceled check copy through something. Those are pretty clean ways for paying utilities and for other things to document. I think that's pretty clean. And if that's opening up an account and then every single debit into that from that account is a qualified cost, then so be it. That's great.
Right. So some documentation recommendations. in addition to setting up a separate bank account, like I said earlier, third-party payroll providers might have some useful reports just to document what parts of the payroll is qualified and what parts aren't, so that you're making sure to be tracking those details. There's specific tax documents are required if you're self-employed, so that's something to make sure that you're keeping your records for this period of time in particular, but probably 2019 and 2020, you'll want to make real sure that you have retained your tax records and all the supporting documentation. And then for everyone, just keep all of your paperwork, keep all of your records, print to PDF. And when in doubt, give the bankers more information to, kind of justify what your actions were in the moment, and then make those required certifications that that you actually used it for payroll costs and the other qualifying costs.
Great. Okay, so our next question was about those federal taxes and so the question was about forgiveness of withholdings for federal taxes. And I know that we went over this once, and Kimberly, you responded, but for the benefit of the whole group, why don't you, if somebody could just clarify, what is the rule about those federal taxes?
So the taxes there was definitely some confusion around that when the statute first came out, and I think the SBA, which I think looks like Eileen maybe pasted some of that in there, and then a little bit continues below. But it's still, I guess, a little bit confusing perhaps. But I think, as Kimberly said, it's based on the gross amount. So you don't, for the purpose of calculating your maximum loan amount at the beginning, you don't deduct the federal taxes, income taxes, and things that are withheld. And other taxes, as far as then the payroll taxes when you're paying them and looking to calculate your amount for forgiveness. Again, you don't deduct those amounts to only use the net amount that the employee receives at the end. It's the gross amount. The only part that's cut out, I guess, or excluded is that the employer side payroll taxes. So it has to be a tax that's either imposed on the employee's wages or withheld from the employee's wages. It can't be a tax that's just paid by the employer for some reason, even if it's related to that employee. If it's a tax that the employer is responsible for, that I don't believe is included as far as the forgivable amount. But otherwise, it's the gross pay for the employer.
And so to sort of maybe simplify, but maybe confuse things, is the net effect is that the employer has to pay the employer's own taxes. You can't use the PPP money to pay your taxes.
I think that's a good way to say it. Yes. Mm-hmm. Yeah. Again, it's supposed to cover essentially payroll costs and the amounts that are required to keep that employee paid from the employee's perspective, I think. So the taxes that are withheld from the employee's compensation are included, but not the taxes that the employer has to pay.
Okay, our next question is from Jody, and Jody says, we have not reduced anyone's wages, but we have cut hours, which has the same effect. What is the base period for comparison when determining whether we reduced by more than 25%?
Good question. That is one I'm going to dig through my notes here because it's somewhat. They look back, I think, at the average. So when the base period for comparing, so sorry, you're asking about the reducing the wages. That one is a little confusing or complicated. So your forgivable amount will be reduced if you decrease by more than 25% the cash compensation of any employee who earns under $100,000 on an annual basis. But I think that 25% figure is misleading because it compared to the cash compensation they received during the most recent full quarter during which the employee was employed before the 8-week period. So, and you're looking at a reduction of more than 25% from the amount they were paid in that quarter, which obviously the quarter is longer than the 8-week period. So while I think the 25% number is a good number to keep in mind, I think the actual reduction could be end up being higher if you reduce their wages by more than 25% overall, because of you're comparing an 8-week period to the quarter. You're going to end up with a different, which I think is about 13 weeks. You're going to end up with a slightly different percentage if you compare it in that way, if that makes sense.
Well, and I will note the ABA, the American Bar Association, put on a presentation about this topic as well. And this was one of the things that they just said, we think this is just plain a mistake, because if you're trying to calculate 25% reduction and you're comparing an 8-week period to a 12-week period, it's always going to be less, right?
It's strange. Yeah, it's strange that they phrase it in that way. So it's possible that they'll clarify or just leave it as is. I mean, I think obviously if you want to be safe, avoid any reduction that exceeds 25% of the annualized amount. If you run into some issues, or if you have some other reductions, I think there's we can look a little closer at the statute and the language and probably come up with an amount or a percentage reduction that still falls within that range. And unless there's any additional guidance or clarification from the SBA that changes it, I think that would be still allowable.
Just remember, you got this loan on the basis of their payroll costs when things weren't in a crisis. So if you're taking this loan out and you got that much money that was based on their payroll costs and you've reduced the amount you've paid them, then materially you've also reduced the amount of the loan. You took out a loan based on those numbers. If you reduce their costs, you should expect to reduce the amount of the loan that you're going to expect to be forgiven, right? So if you said that you're going to pay somebody 80% of what you'd paid them in a year before, then your loan amount should in theory only reflect 80% because your payroll costs are going to go down by 20%. I'm trying to make sure I'm trying to say that in a way that makes sense. But if you're reducing people's wages on that side, then it would have reduced your maximum eligible loan amount if you'd paid them less during that period as well. And again, there's no requirement to spend all the money. Just if you're going to reduce people's wages and you bring them back, and if it's 60% of what you'd paid them before, and you pay 60% of those wages, or pay those wages with the money, but only spend 60% of the loan dollars on the payroll pieces, may be looked at differently than taking out the loan and then spending the rest of the money on something else, but you're still saying I'm spending it on payroll, that you're reducing some people but not others.
Right. So I think Craig makes a good point that it's obviously even if you're reducing whether it's hours or salary by some amount during that period, even if it's still included in the forgivable amount, you may not be paying the amount. You may not be able to meet that threshold that you need to meet to make sure you're hitting 75%, or just use the entire amount of your PPP loan. So that's another thing to consider. And I think the question kind of asked about both hours and wages. So I think, obviously there's a question about the reduction in wages for anyone earning under $100,000 on an annualized basis. But then there's also the question of reducing the hours. And for that, they look at kind of the average number of full-time equivalent employees during the 8-week period. And they compare that to the average number of full-time equivalent employees during either the entire period of the PPP loan program, which is, I think February 15th to June 30th, or the period from January 20th to February 20, the end of February. So, or from, I think, beginning of basically the month of January and February. So you can kind of pick and choose which one seems to work in that case. But generally, they're comparing the average number of full-time equivalent employees from one of those periods to where you were during that 8-week period. So even if you've reduced some hours, depending on where you were before that, and again, you can always either one of those, the salary reduction or the reduction in employees, as long as you put that back to quote unquote normal before June 30th, it won't. So if you do return that to its normal level before June 30th, it won't be, your total forgiveness amount won't be reduced. And in the case of employees, I think, as Craig mentioned earlier, if you make a good faith offer to an employee who refuses to come back for whatever reason, as long as you document that and show clearly that you made a written offer and that it was refused, your forgivable amount will not be reduced because that employee refused to come back. Obviously, that's kind of outside of your control. So as long as you made a good faith effort to try to bring them back, they'll consider that as if you did.
Okay, so, and that actually ties into our next question. Kristen asked, when does the number of employees count? Is it as of December 31st, February 2020, when the funds are received in the bank account? And I think you just went into that calculation, Nate, but essentially it's a pick and choose, correct?
Yeah, so you're going to compare the average number of your full-time equivalent employees during your 8-week period after you receive the loan funds, and then you can pick whether you want to compare that number to the average number of full-time equivalent employees during the entire period of the Paycheck Protection Program loan offering, which is I think February 15th to June 30th, or the earlier period from during the months of January and February. So, because obviously there may have been some reduction, and one of those times you can kind of pick and choose which one seems to work best for you and compare it to that 8-week period. And it's going to compare sort of overall full-time equivalent employees. So even if you have some part-time employees or people have shifted up or down one way or another, it's kind of going to take that in the aggregate.
And so as we were talking here, I just noticed that Kimberly did type out the actual calculation. So for people who are interested in going a little deeper here, if you look at Kimberly's 2 most recent comments, she spells out the exact language of the periods where you're looking at your full-time equivalent employees. So thanks for that, Kimberly.
Yep. And I would also say we've seen some confusion from people who say the application just said number of employees on the application. So if you had 20 employees, 10 full-time and 10 part-time, they're like, did I make a mistake by saying I have 20 employees then, because technically I guess I have 15 full-time employee equivalents, or those part-time employees actually work 32 hours. So do I need to count them as 0.75 each or whatever like this, or 0.8 for each one? And a lot of the guidance that we've been giving folks is to not sweat it, provided your employment looks the same in terms of payroll costs of what it did when you made that calculation. And there is some wiggle room in there too. Again, you shouldn't be spending the money if you don't have those employees anymore. If you had in 2019, you had 10 employees, and at the end of 2019, somebody decided they weren't going to continue working for your company and left, and then you have 9 employees instead of 10, you calculated your 2019 payroll costs based on 10 employees. That just means you can't expect that 10th employee's payroll cost to be forgiven, and because of what you did with those costs, unless you could demonstrate that employee wasn't that they weren't brought back because of COVID related issues, and you spread the salary among the rest of your employees to make up the difference, to carry the load, et cetera. Just be consistent, I guess, is the biggest advice that we have, is that same way with costs paid versus incurred. If you do it one way, make sure you do it the other way. Same thing with calculating your 8-week period. We've been given different guidance at the SBA level that it could be the date from your E-Tran number to the date that your loan documents are dated to the date that you actually receive your funds. Any of those 3 dates can be eligible potentially for your 8-week period if you are consistent in including those as your 8 weeks. So you can't say, well, I'm going to use this one because it was 8 weeks from the date that I got my E-Tran number, and then I'll use this one because that's 8 weeks from the date I got funded, but in between is 9.5 weeks. You have to basically pick which 8-week period is and stick with it and be consistent.
Okay, and then this is also, so I think we just addressed this question. Kathy had asked, are we talking about same number of employees or same amount of FTE? I think we're all in agreement that it's FTE. And then Sarah says, if our utilities are less than 25%, can we use the remainder for payroll, retirement, health insurance? One of you want to take that one?
I'll take that one. So I think we would recommend looking at it kind of flipping the equation around. So you want to make sure that payroll is 75% or more. And to be conservative, maybe 80%, 85% is a good number to look at, and make sure that you use that amount. It has to be more than 75% on payroll, and then you can decide whether it's utilities or rent or other costs. Then you can decide how to spread the remainder out. You can also use the entire thing for payroll. There's nothing in there that says you cannot. So if you don't have, 25% of non-payroll qualifying expenses, that's okay. So you want to just make sure that you're, the retirement, the health insurance, and the cash, those are all appropriate for using for those payroll costs, and they're qualifying. So when in doubt, just use it for payroll. And then if you have money left over, those other qualified expenses, you can use the remainder on.
Or pay it back.
Okay,
Yep.
so Patrick asked for
Don't
employees
pay it back.
for employees who make over 100,000, do salary and wages need to be split into payments for below 100,000 and over 100,000 for each check, or can it be paid with PPP funds until the 15,384 limit? That's a great question. I'd love to hear what the panelists think.
We've told folks to be circumspect and smart about it, and it's why I've actually recommended not moving your payroll to a new dedicated account if you have employees who make over $100,000, but rather writing a check to reimburse that account, if you will, for the amount that it was, to track how much of it was actually for payroll. Switching your payroll comes with a whole litany of legal potential ramifications of your payroll company screws up or doesn't take it on time, then you don't pay your employees on time, or they take it from an old account. It creates a whole network of issues. If you do open up a new account for your PPP funds, have it keep taking payroll out of your payroll account and then document it with a transfer or something. And then that does kind of limit that. If you have an employee who makes over $100,000, you can just transfer the amount that's inclusive of all amounts up to $100,000 and less the amount that would be below it, or $8,333 or whatever that is per pay period, or per month.
And just to be clear, I think it's actually not 8,333. I just don't want to mislead anyone. From what I've said, it is that 15,384, because that's the 8 week period.
That's 8 weeks, not 2 months. Yeah. There we go.
Okay, next.
Yeah, I calculated that just for folks who are interested, is that an employee who earns $100,000 annually will we basically just take $100,000 and multiply that by 8 over 8 weeks over 52 weeks. So we're just multiplying, what you get paid on a weekly basis. And the other number is if you just calculate it for 12 months, which is not as accurate. So we're recommending that 15,384 number.
Math.
Okay, so next question. If I am a partner in a partnership LLC and only put our employees' info down on the application, am I allowed to spend some of the loan on our partnership distributions to my partner and myself and have that still count as payroll? I think the consensus there is yes, but does anybody want to expand on that?
Yeah, I can take that. So I think generally speaking, I think that your owner, I think they call it owner replacement compensation, could have been included to calculate your maximum loan amount. But I don't think the fact that you didn't include that in there prevents you from using it. You could have taken out less than your maximum loan amount, even if you had included it. So I think as long as it's reasonable and in line with payments that were made, previously, I don't imagine there would be any question or concern about it, or at least I haven't seen any guidance from the SBA that would seem to exclude that. In fact, broadly speaking, they want to include partners or members in an LLC that's taxed as a partnership in that employee compensation, rather than them applying separately for their own PPP loan for obvious reasons. So I think including that draw, again, as long as it's reasonable and in line with compensation that have been paid reasonably, I wouldn't think it would draw any ire.
Yeah, under the statute, the term employee means all of your full and part-time employees, not independent contractors who have a principal place of residence in the United States, and all owners. So the fact that you don't get W-2 income doesn't preclude you from taking out up to that maximum amount that we just talked about. So if you're paying yourself extra as a distribution, then that needs to come from another source.
But be cautious if you didn't do that in 2019 and then you have some leftover funds used for this and you're going to pay yourself $15,394. You might have a problem on your hands because you didn't do that in 2019, and doing it now could look like you're paying yourself out of government money because it's convenient to do so. And
so just regular business practices.
Exactly.
Okay, next question. Are payroll processing fees, FSA processing fees, 401k processing fees allowable under payroll costs? And I think the question there again is, are those fees forgivable?
We calculated them as costs when we were helping people through because it is a true cost of doing it. But if it's a one-time annual cost, you should probably divide it by the 8-week period, the same way you do multiply it by 8 and then divide by 52. Or if it's a cost that's incurred each one of those months, then you can include that as a cost, was our understanding, because it was the cost of offering those services.
And so you're calculating them as payroll costs, not the rent, utilities, other costs.
I guess that they should be relatively minimal in terms of your overall calculation. And if there's ever wiggle room, I would say count them as the less inclusive category of non-payroll costs, like rent and utilities, just to give yourself the cushion. But that they would still be allowed to be included as something that's not an excluded payroll. Would you two agree, other panelists?
Yeah, I think I would, if you're close to that 75% threshold, I certainly wouldn't count on those fees to put you over the top. You might end up losing out on some of the other costs that I don't recall seeing anything in the statute or the guidance that specifically mentioned those fees. I think, as Craig said, you just, make sure you include what would be considered an appropriate amount. So whether it's prorated for that period, or if it's something that otherwise is typically paid at some other time of the year and you try to just pay it during that period to try to include it in there. I'd be careful about some of those things, but make sure you're not, otherwise close to the edge of that 75% and relying on that to put you over the top, because you might end up missing out on that, as well as some of the other expenses that then get deducted.
Yeah, and I think that this is one area where, if you have those types of specific questions and you have a banker that you can talk to, it would make sense to get in touch with them sooner rather than later to verify how they're actually interpreting the law and all of the interim final rules. So, while Craig and Beneficial State Bank may interpret those as included, some banks may read it differently. And so you want to get an answer from your lender.
Okay, next question. If a lump sum bonus is given to an employee who makes well under $100,000, do we need to apply the same cap as we do to our high earners, since the employee would fall into that bracket for the payroll the bonus was included in?
Yeah, I think so. I think it's looking at it on kind of an annualized basis and prorating it for that 8-week period. So even if they make $25,000 on an annualized, that's their normal salary. If you give them a $25,000 bonus during that 8-week period, it would exceed that $15,000, kind of threshold or cap. So I think you want to be careful of it. The statute does seem clear about prorating it for that period, as opposed to then looking kind of more broadly at the year. So that employee, for example, maybe would only earn $50,000 over the year. But if over $25,000 of it was paid during that 8-week period, I think anything over that $15,384 cap would be excluded.
Yeah, and you can still pay them that. You just can't use PPP money to do it. So I think
Right.
that's the good differentiator, right? It's not that employees can make over $100,000 a year, that you don't have to reduce them to that to qualify for this program. We thought we had people thinking they had to make sure that people didn't make it, that they were going to track for the whole year to make sure those people made less than $100,000. And it's like, no, you can only include that in your calculations for forgiveness from the PPP money you use to pay those employees.
That's a great point. Thanks, Craig. Let's see. So then we have from Cheryl, what about employees who make over $100,000 during the year? For purposes of figuring out the employee's retirement contribution, say it's a 3% matching situation, would the employer retirement contribution be figured on the entire wages paid to that employee for the 8 weeks, or limited to the $15,384 wage amount? So
if it's a match, our understanding was that the match, it's going to be based on that pay period that you're matching, right? So that then if it wouldn't be for something you're paying out of pocket later. So if you paid somebody $10,000 during this pay period, that'd be what? There'd be $3,000 or it'd be $300 in that time frame that would be included as your payroll, as the cost that you can include as the employer paid benefit.
And I think your last comment is also appropriate here, Craig, is that you can pay more than the 15, you can pay the person more than the 15,384, and you can pay them, you can have their matching be greater than that as well. You just can't use PPP money for it. And I'm hoping that that's a helpful answer, Cheryl. Let us know if you need more. Okay. Jane asks, I understand vacation and sick pay is forgiven. What about paid time off, a PTO to pay out for people who have large PTO accruals?
We would think that would still be covered in our mind over here because that's a benefit that they've earned as part of their employment in most situations. And if they're taking that vacation, sick time, PTO, provided it's not the FFCRA qualified leave, that we would be considering that they're still employed. They're just taking time off for whatever reason it is. They're still being paid their wages for that time off.
Okay, but you still would want to I guess, is vacation or paid? I guess this is one of the things I struggle with. The PTO, that would not be considered wages, right? Or would that be considered subject to the $100,000 wage cap?
That would be subject to the $100,000 wage cap. So if you have an employer that makes over $100,000, you'll be paying your expenses above and beyond what's allowable for the PPP. But you're going to process payroll just as if that person, let's say they took the entire month off with their own PTO and not under the emergency family leave, then you're going to be able to cover 100%. But the PPP money, again, just has to be capped.
Yeah, and the clarification that Daniel just typed in, I think it sounds like the question is, what if you say, so let's say an employee has a lot of paid time off, you give them cash in exchange for that paid time off and reduce the amount of time that they actually take off, not if they actually take it. Does that make sense?
Yeah, the statute refers to payment for vacation. It doesn't specifically refer to like payout for paid time off or anything, but I guess my understanding or my argument without any further additional guidance would be that I think within reason that would be an allowable expense, and it doesn't appear that it would be included in that $100,000 cap for cash compensation, because that pretty clearly refers to wages and salary, tips, things like that, and separately then refers to payment for vacation and insurance premiums and things like that. So again, with everything, I'd be somewhat careful of not dumping a bunch of funds on something like that for people who have high PTO that's available for payout. At the same time, it's again, at least you're if you're gonna take a risk, I guess, or make an assumption, do it on the side of paying your employees a little extra, however that might be, because that I still think would fall within line of the purpose of the program. So it'd be a good faith argument that it was, it should still be an allowable or forgivable expense.
Okay, let's see. So our next question is about Schedule C income for self-employed. So what if you're self-employed, commission-based income with no employees, and your loan was awarded before you had a Schedule C available? Now the Schedule C shows a lower income, which means if I used 75% of the loan to pay myself, I will have paid myself more than the Schedule C. How should I handle this in order to qualify for forgiveness?
So the SBA should be issuing additional guidance for this particular situation, because currently it's not super clear. And so, those who are Those individuals who did not operate in 2019, but then eligible because they were in business, that's something that is not entirely clear. I think that, if you can show that you were being paid more in 2020 than in 2019, it's just more of a conversation with your banker as far as what your documentation needs to show. So if you gave yourself a raise in 2020, then you want to make sure that you're using the most, that your banker agrees with you, that that's allowable. Is that the way you interpret it, Nate?
Yeah, and I'd of course also be interested to hear what Craig has to say, but I think I understand the question or the issue, and I think, obviously my understanding of the upfront process for determining the maximum amount was to use the Schedule C from 2019, but because all the tax dates were pushed back, a lot of people had not completed or filed those yet. I think my understanding is that even if you hadn't filed it, you were supposed to essentially prepare it as if you were going to file it and then use that information. Obviously, there may be, if it's not actually filed, there may be differences in it. So I think the safest route would be to just use 75% of it to pay yourself to hit whatever was on that 2019 Schedule C, and then either repay the rest as a loan or just give it back at the end of, whenever that request for forgiveness is made. But I think there is, again, as Kimberly said, the SBA hopefully will come out with some more guidance related to the way self-employed and sole proprietors have to deal with these funds, because it's a little bit different. But there are a number of indications in the statute and in the existing guidance that is somewhat limiting for self-employed individuals and based on their 2019 tax form. So whether it's that compensation or earnings, or even some of the allowable expenses. So you may end up having to repay that additional 25%. So maybe holding off on that to use it until after you find out whether that's going to be forgivable or not, and then making a decision if you want to pay yourself that money and just pay it back at 1%, obviously, or just return it to kind of avoid the hassle. But I think there certainly is a question about whether that would be forgivable or not.
And that's what we've been doing too, is to tell folks, if you're self-employed, you have a little bit of flexibility because you're paying yourself versus a bunch of other employees. If you pay yourself and they determine that you did too much, in theory, you could give it back to get yourself back in line with forgiveness because it's just your own money. Whereas if you paid 10 employees and then you can't really ask the employees to give the money back to pay the loan, it's a lot stickier.
And there are two follow-up questions. So Kate, who asked that original question, says, is the forgiven portion 75% of the money spent versus the loan amount? So that's follow-up question one. And then Carrie says, if the answer is loan amount, can we take out a loan for less than the approved amount?
I got a lot on this one, if you all
Go for it.
So we've been telling folks to take out less than they've been qualified for as a good faith thing anyway, because then you're automatically building in a bit of a buffer that you could have qualified for more, potentially to make a good faith argument that you only took what you needed. If you took something out and then didn't spend it all, the 75% is on the money spent, is our understanding. So that's what we've been given all along. That if you took out $100,000, spent 60, and you gave 40 back, the 40 you gave back, then it's like, okay, it's now 75% of the $60,000 you spent. Which is also a good way that if you're uncertain on something, rather than just spending the money and trying to see if you could fit something into a payroll cost category, you can give it back, and then it actually reduces your denominator a bit so that you're actually, what you did pay towards payroll is a larger percentage of the money.
Okay, thanks, Craig. Next question, is interest accruing on the loan now? And will all of that be included in the forgiveness percentage?
Anything, our understanding is the bank is anything that is forgiven, the interest will be forgiven right along with it. If you have money that isn't forgiven, it will have been accruing 1% interest this whole time. It just won't be due until the interest will all be deferred until the 6-month period of loan payments begin. So if you got a loan today, you'd be paying the day after you vote in November.
Okay.
Or 2 weeks before if you're in Oregon, because you should vote as soon as you can. PSA.
The statute does say that your maximum forgivable amount is the amount of the loan, but there's also language elsewhere that says if the entire amount is forgiven, you won't owe anything. So you won't owe principal or interest. But as Craig said, if 90% of your loan is forgiven, that the interest that would have otherwise accrued on that amount is you don't have to pay that, but you would have to pay any interest that accrued on the 10% that isn't forgiven for that whatever period until you make that determination.
Yeah, so again, just to be overly cautious on this point, 75% is, 25% of non-payroll costs is the maximum that you can spend on non-payroll costs. So it's our recommendation that you go up to 80% or 85% and you spend as much as you can on payroll. And then, then you'll have that comfortable cushion and you can spend it on the other qualified costs that are not payroll. So I would not push it to that very limit of the 75-25, but maybe think more 80-20 or maybe even 85-15 if you can make those numbers work for your organization.
And I guess I don't know if we mentioned this at the outset, but where that ratio, the 75-25 comes from is so again, the primary purpose of the program is to help keep employees employed and paid during this 8-week period. So they took 2.5 times your average monthly payroll. So obviously 2.5, they give you that little extra, not just being twice as much, they give you a little extra to cover some additional expenses. But they want to make sure that 75% of it is used for payroll. But then they understand that because they're multiplying it by a time that's longer than the 8-week period you have to use it, that you're going to have some additional funds that could be used for other things. So focusing on that, like Kimberly said, we focus on making sure you use at least 75% of it or hopefully more on payroll to give yourself a little buffer. And then anything that you use on those other expenses hopefully will be forgiven as well, but focusing primarily on the payroll.
Okay, I'm going to lump the next two questions together because I think we've talked about at least in tangent about both of them, and I think they can kind of be answered together. So one question is, in Craig's example of option 2, $100,000 loan, could $65,000 in payroll and $19,500, 25% in non-payroll, essentially rent, for a total of $84,500 be forgivable? And then the next question says, which I think these are asking similar questions. I'm still confused about the partial forgiveness. I thought if I don't spend 75% on payroll, that the whole thing wouldn't be eligible for forgiveness, not just the difference.
Yeah, and my response there was actually meant in somewhat of with Gaia's response here, not with Carrie's here. But the part of that we've been really wanting more clarification on is if you spend 75% of the amount you spend on payroll costs, you get the whole thing forgiven, as long as the 25% is eligible. If you spend 74%, what happens is none of it forgivable. And that's been the hard part about this, but the guidance we've been given is this understanding that what you spend on payroll costs will be forgiven, provided that you're not spending all the rest of the money just on working capital and things you didn't say you'd be spending it on. But that's been our understanding from the SBA has kind of massaged its way around saying to banks of the forgiveness amount will be based on payroll, provided it's a substantive amount of the loan. So if you did 10% of this loan on payroll, I don't know that they're going to give you 10% forgiveness because you're really not following the guidelines. But if you spend 50 to 74.9%, the understanding is that they would work with you on forgiveness of some amount, but that you're going to have an amount that isn't fully forgiven.
Yeah. And that's my understanding as well, that if you, for example, had a 70%, 70-30 split, a portion of the 30% of non-payroll costs would be excluded to get you back down to that 75-25 ratio. So I think most of it would still be forgiven. You would just end up with a portion of your non-payroll, the mortgage, the rent, and utilities that is not forgiven to get you back in line with the ratio that they want. So again, and that's I think like Kimberly mentioned and Craig as well, focusing on keeping that payroll amount up high enough where you're not right on that line. And even if you are, the risk is just that you'll have to repay a portion of the other expenses, which may not be a concern, but trying as much as you can to use a majority of the funds for payroll to make sure you're not causing any issues or questions about what the funds were used for, or whether you met the guidance or the certifications that you made on the front and back end in the process.
Yeah, and to not lose sight of the forest through the trees is kind of some of what the advice we've been giving too. If you're so hell bent on hitting 75% payroll cost, so it's all forgiven, whereas you're actually like walking over money, if it's $5,000 is what you need to finish this piece to pivot. Like, just remember that some of this element over here is that because the money was free, some people are losing sight of 1% on what wasn't forgiven with the two. Like that's really screaming low. You're not going to be able to find that from a bank. So right. I know a lot of nonprofits who are totally afraid of debt and think, I get that there's the fear of God in this, but also be cognizant of the fact that if you're in good faith using it and there's something that you really do need to pay to keep yourself in business, is it better to stay in business and have a few $1,000s in debt than, well, at least I got it all forgiven, but now we're out of business.
Yeah.
Okay, I'm going to move on to the next question, which is from Eric, who asks, a LLC member has one employee, W-2, and the member pays himself via guaranteed payments and distributions. Can the LLC member claim the guaranteed payments as a payroll expense, distributions, the K-1 profit portion? So I think we may have addressed this earlier, but let's just reiterate the answer.
Yeah, I think it's based again on the earnings or earnings from self-employment that were reported in the 2019 taxes that and I think as we mentioned before, there are some questions about whether there's an upper limit on that based on 2019, but otherwise I think as long as those payments are consistent and reasonable, I wouldn't imagine there'd be any issue with it.
Yeah, you just have to make sure that it doesn't exceed that $100,000 annualized cap.
Yeah.
And we had on payroll costs, just at the bank about how you paid yourself as a K-1, that if you paid yourself as an owner's share, and yes, owners are considered employees, that they're included as payroll cost pieces, but for maximum loan calculation, there was a little bit of guidance that if you did a K-1 as like a profit owner's expense, basically where they just paid you, like this was profit, I just took it out for 2019, you couldn't just use that piece unless you did consider it earnings. Was basically there was a different way that people could put it on K-1 versus profit versus earnings slightly. So just being cognizant of when you're calculating your loan amount, that some K-1s could show a huge amount of profit and no wage, basically, or some that could show wage and no profit. So being cognizant of that there is a bit of softness between there, you should probably talk to your CPA or attorney about if you're trying to use them as the backbone for a loan application.
Okay, I'm going to gloss over the next question, which is about tracking expenses. I think we've talked a lot about that. If there are still questions at the end, feel free to contact us separately. Okay, so Michelle asked, you have really cleared up the federal taxes question for employer-employee relationships. Thank you. Can you elaborate for sole proprietors? Would estimated quarterly federal and state taxes be forgivable as an LLC or sole proprietor?
And so is this in the case of sole proprietor, and so not a partner or a member in LLC taxed as a partnership as far as calculating those expenses? I believe those would be included because they would be considered, well, let me pause on that and think about it through. That's a great question. I think that's one that probably would need to be looked at a little more. I know there, like I said before, there are some kind of particular or peculiar rules related to self-employment and some limits on what can and cannot be included in there. So I would want to take a look rather than steer you in the wrong direction. I don't know if Craig or Kimberly has any thoughts on it.
It would seem that the state taxes at least would be forgivable, right? I think it's the federal taxes that might, right? Well,
and it really depends on how your entity is taxed. So if you're an LLC and it's a sole proprietor or a single member LLC, it'll be taxed just as if you are a sole proprietor. And so, the guidance there, and Nate, I know, is looking for the specifics here, but the guidance is that you need to limit those expenditures. So for other payments, not the payroll expenses, to those that were claimed or entitled to a deduction on your Schedule C for the 2019 Form 1040. So you just want to be cognizant that that for the non-payroll and non-payroll amounts, that you want to make sure that you don't exceed what was done in 2019. And then if you are paying, so if you're sole proprietor, you're going to be paying the self-employment income, and so you're paying both sides. You're paying employer and employee costs. So Nate, do you have any guidance there on how that's handled?
I am looking.
Okay.
Haven't found it.
Well, let's let Nate off the hook for the moment. And if you have a chance to find it, we can revisit it if you do find it before we sign off. Otherwise, Michelle, please feel free to get in touch with us after the presentation, and we'll try to get you a more precise answer on that question. The next question is from Shelley, who says, I read that 8 weeks of 2019 Schedule C income is automatically forgiven. True or false?
I'm not sure about the phrasing of that, the automatic, but I think perhaps the essence of that if you have, whatever 8 weeks of your, earnings from self-employment were from your Schedule C for 2019, you could easily pay yourself that during the 8-week period and have that forgiven. If you didn't pay yourself that, I don't know that you would have it forgiven because it wasn't actually paid during that or even incurred during that 8-week period. So I think you would still have to pay yourself that, and I might just be misinterpreting the question. But I think if what you mean is can you just pay yourself that regardless of how much you're working or what you're doing during that time, because it's earnings from self-employment. I think my understanding is you could easily request forgiveness for whatever that portion of your 2019 earnings from self-employment was, and have that forgiven.
Yeah, totally. That's my understanding as well. Just remember, there's nothing automatic about this program at all. So it's not like the EIDL program with the SBA where you're able to apply and it's just a grant and there's nothing that happens. You are signing loan documents with your bank where you get this as a loan, and it will be your responsibility to petition for forgiveness when the time comes to demonstrate that. And if automatically means that those 8 weeks, yeah, absolutely. If those 8 weeks are measured on your 2019 taxes and you could show them, and regardless of whether or not you did the work, in theory, you're still paying yourself as a Schedule C income. If there was no work to do, that's literally what this is doing, is keeping you from going on unemployment. So it should work. Just remember that automatically is the caveat where you are going to have to file some paperwork and let people know that you needed this forgiven.
Okay, so then a question from Kristen, who says, for example, we had 10 employees in March, but then 8 employees at the end of April. Do you take the average between February and June? And I think that this is answered by the text of the statute that Kimberly shared. So Kristen, I'm gonna, in the interest of time, just ask you to refer back to that. If you still have questions, please do feel free to reach out to us after the webinar. As you'll see, we've posted our phone number at the end of the chat here. So if anyone does have follow-up questions, or I've asked you to get in touch with us after the webinar, there's the phone number. Okay, let's see, where were we? A bunch of stuff. We're getting to the end here, guys. Thanks so much for hanging in with us. So the next question, Shelley says, we pay our employees until 6:30, but our business is still closed and we do not have funds to continue to pay them, so they have to go on furlough again. Does this affect the forgiveness?
If I understand the question correctly, I don't think that it would. Again, as long as, like you said, if you continue to employ them and pay them, and otherwise, so the forgivable amount isn't reduced for one of those reasons, I think anything after that is not necessarily considered for your request for forgiveness. There may be some issues otherwise for them to claim unemployment or other things, but I don't, as far as I understand, I don't think there would be any issue as far as your application or your request for forgiveness, as long as you still meet all the other requirements for maintaining the salary levels and employee headcount, or full-time equivalent headcount, I guess I should say, for up through that period rather of June 30th.
Yep. And Shelley, you hit it on the head. It's if you got this loan on April 15th and June 13th was the end of your loan period, you would need to continue paying your employees through June 30th to qualify for forgiveness. But as long as you pay your people through June 30th and the end of the 8-week program, you should be totally fine. Provided you spend it on the right things, of course.
Thanks for that clarification, Craig. Okay, so we're getting toward the end here. Jane asks, we get a $125,000 loan. We spend $75,000 on payroll and $25,000 on other eligible expenses. What happens to the remaining $25,000? Do we pay it back to the bank on June 30th?
That's one of your two options. The other one is that it is now going to be owed at 1% as a loan. So you're still allowed to take that out if you don't, but if you want it forgiven, you have to then pay it back, right? There's no just getting to keep it. So it is something that's a lot of things I'm telling folks is that if you don't spend it all, this is a really great buffer for you to potentially have as something to continue paying your staff or pivot or do anything that amount is at 1%. And so $25,000 at 1%, that's going to be due at the end of that 8-week period. You wouldn't have payments for another 4 months after that, plus 18 months of equal payments. Maybe that's something with no prepayment penalty, meaning you could pay it back at any time if you just decided we're good. There's no prepayment penalty, just interest due to that point. So that's a pretty clean way. If you needed to give yourself a little bit of a buffer, maybe you don't spend it all and you have a little bit of an extra back line, even if it's at 1%, that there were deposit accounts paying 1% not that long ago, so that's a pretty cheap cost opportunity for you to decide whether or not if this is something that you'd want to continue to have or just pay back.
Yeah, and the other thing to note is that, if 75,000 is your limit on how much, you can pay in payroll, then that's one thing. But if you have additional payroll expenses, which also include the retirement, the health care, and the withholdings on the for state and local taxes, those you can pay more towards payroll. And I would encourage you to spend more than just that bare bone 75-25 split, but make sure that you're padding it on the payroll side so that you're spending a little bit more than 75% on the payroll.
Okay, and I think our last question from the day comes from Kristen, who says, we have an owner who adjusts their pay with each payroll, sometimes taking 0, sometimes taking less than half of what they usually would. Can they get paid their salary they should have been getting, or do we need to stay in line with our payroll reporting for the previous year? Panelists?
So the amount of payroll that was spent in the previous year, if that was, or in the 12 months preceding the loan, that was what was used to calculate the amount of the PPP loan. But as long as you're sticking to less than $100,000 annualized salary, then you can make adjustments, in terms of how much each person gets paid. That's not the case for self-employed individuals, sole proprietors, because you're looking at those tax returns. But in the case of employees, it's more about just maintaining the number of employees for that 8-week period.
Okay.
Yeah, I think.
Is there anything else on that one?
I guess, Craig, I don't anticipate that you'll be looking at, when you're evaluating for forgiveness, you're going to be looking at the true payroll amount and the number of employees and comparing it from start to finish rather than looking at each individual employee and comparing that.
Right. And we will spot check against highly compensated employees. And we're
Right.
just for the terms of this highly compensated being $100,000 a year or more in salary. So we will check against that. But in general, a lot of the ballparking that happens, you could tell with payroll if there's 5 employees, and that for that 2-week period, and it's $30,000 or something like that. You're like, okay, well that could be in the ballpark, but if it's $60,000, there's going to be some like somebody's making more than this amount of money. But in general, if we're just going to keep tabs on when you provide the payroll reports, most of the time they're going to be line by line on those about what each employee got paid, and we can just be able to scroll through it. And I would expect if you use a payroll provider like ADP or Paychex or whoever that you Paycom, they provided a lot of PPP CARES Act reports for helping you calculate the maximum cost of your loans. I would very much expect that they're going to provide something very similar as an automated generated report for you to use for your calculation pieces. That's a guess, but I feel like it's a pretty safe one because people are going to be asking their payroll providers for this information manually. They're eventually just going to generate a report that just grabs only the data that's needed.
Yeah, that's what we're seeing with our payroll provider, Gusto.
Mm-hmm. That's another big one. Yep.
Okay, so we've gotten to the end of our questions, and thank you everyone for sticking with us, and thank you panelists for staying to answer every last question. I've included all of our email addresses in the chat box as well as the Catalyst Law phone number. So if you do have follow-up questions, just pick one of us and get in touch. A few final notes is, again, that this was not intended to be legal advice and that we are not your lawyers unless we have a separate engagement agreement. A few special offers. So we always do free 15-minute phone consultation. And during the period of the pandemic, we are also offering $199 hour-long consultations, which is a significant discount on our hourly rates. We are also happy to talk through with you documentation of your PPP forgiveness requests. And as Kimberly mentioned, that can also include advocating for you with your lender or the SBA should it come down to it on a forgiveness matter. And finally, a reminder that we are continuing to do this webinar series throughout the period of the pandemic and after. So please go ahead to our website, catalystlawllc.com. We did one a few weeks ago with Craig as well, where we talked about how to apply for the PPP program. And then we've got some other additional resources specific to COVID-19 related advice. So don't hesitate to get in touch if we can answer some questions. And thanks so much for joining us.
Thanks, everyone. Have a good evening.
Yeah.
Thanks, everyone.
Cinco de Mayo.
Happy Cinco de Mayo.